The best way to find stocks that are likely to be strong in the future is to find stocks that are strong now. The stock market is both hyper efficient and forward looking, meaning that whatever is priced in now is what is likely to occur in the future. When Tesla finally began to turn a profit so that their PE ratio could actually be calculated, their first value for their PE ratio came in at an insanely high 512. Value investors hated this company. During that period, the price of Tesla was less than $72, ends up reaching a peak of $360. People have been calling Nvidia extremely overvalued since 2020 when its PE ratio jumps up to nearly 80. At that time, Nvidia is trading at $10.50 a share, whereas now it is trading over $140 a share. And I want you to notice something about these two charts, being Nvidia and Tesla. The PE ratio spikes. Then a few quarters later, the earnings begin to grow rapidly. The PE ratio spikes, then the earnings begin to grow rapidly. That is your hyper efficiency of a forward-looking market at work. That is the market seeing the future, seeing the growth that is likely to come for this company and beginning to price it in before it actually does. So within your active trade software, if you could chart the PE ratios and build a scanner to return stocks using that information, it would be like a superpower, being able to see into the future. Hopping back to our macro trends chart here, looking at Nvidia, we get this sort of spike up over 140 on the PE ratio during mid-2023 to fading back off and now currently sitting at 67. Does that look pretty similar to my indicator here in 2023, sitting at about 160, 150? I have on my value currently sitting at 65. If you can't tell yet, I have figured out how to build a custom study to live chart the PE ratio and to pull this information into a scanner. So in today's video, we're just going to go over a handful of past examples of PE spikes leading to huge future gains and take a look at maybe what's setting up right now. First, let's take a look at LLY, Eli Lilly. Since the start of 2021, this company is up over 450%. An absolutely insane stock. And since the start of 2021, the PE ratio has been doing nothing but going straight up alongside the price. I mean, this thing spikes from pre-2021 from a 20 value PE ratio up to a 43 value PE ratio. That's already, first off, 100% PE growth, but 43 is a pretty high value. I mean, the company is currently trading at 43 times what it is making right now. That is pretty extreme expected growth for the future of this thing. And at that time, the stock is trading at $270, has still done up over 240% since then. Next, let's talk about Celsius, the energy drink brand that at one point was the largest gaining stock in the stock market over the last 5 years. Now, that's probably not true anymore. They've fallen off really hard, but they did get a huge, just massive spike in their PE ratio. Now, this is sort of because they're flirting with profitability. I mean, you take the current closing price and you divide it by 0.01. Of course, you're going to have a ridiculously high PE ratio. But this just goes to show, even before they were really making money, before they even really had real earnings, the market was already beginning to price in future growth. When this PE ratio begins spiking and the price also begins spiking alongside of it, the stock still goes here from $20 up to $100, being a nearly 400% gainer. And right here's the perfect time to take a second before we move into the scanner and look at stocks potentially setting up for moves right now and talk about this. Because yes, Celsius has a massive crush here. And guess what? Yes, we are buying very overvalued stocks that may be / are likely to return back to earth. And you've all probably heard the Warren Buffett quotes or read The Intelligent Investor by Benjamin Graham that tell you how you should be looking for undervalued stocks. And they're not wrong. This is not at all me trying to discredit Warren Buffett and Benjamin Graham. They're obviously genius investors, but they are value investors. There's a whole nother half of the investing community, a whole nother type of stock called a growth stock. So the stock isn't currently trading under what it should be valued at. It is currently trading based on expected future growth. And these stocks are going to provide a lot more volatility. Now, that includes downside volatility. But for those of us that are more active traders, probably you watching this video, and we probably don't have accounts as large as Mr. Buffett and Benjamin Graham, even when they were getting started, we're probably interested in looking for the more volatile direct moves. That's what this is doing. We are looking at growth stocks. Yes, we are buying overvalued stocks. But once again, the efficiency of the market, they are overvalued for a reason. The market is pricing in potential future growth, as you've already seen with the handful of examples we've gone over. So let's talk about the scanner. First off, I have 2 stock filters on that just keep out a lot of the riffraff. Show me stocks that are at least trading $5 a share and with at least 100,000 shares of volume. Now, down to the meat and potatoes, I have 2 fundamental filter types turned on. The first being that the current PE ratio is at least 50. These are companies trading 50 times their current earnings, very high PE ratios, and that the EPS over the last 3 years has averaged out to positives. I don't want to see companies that are losing money. Those end up breaking the PE ratio. Obviously, if you're not making money, you can't divide by 0. This ends up getting broken. They're not really the kind of growth stocks we want to be looking at anyway. Anyway, the first 2 tickers on this list, sorted top down by volume, are NVIDIA and Tesla, which we've already looked at. Next, though, we have BSX, Bravo Sierra X-ray. If we jump over to our charts and load this in, you will indeed see a very high price to earnings ratio, currently at 70 times their current earnings. But even look back here when this thing went from not making really any money to jumping up on their PE ratio, it jumps up to 50, and then from 50 up to over 100. That's a huge gain in PE ratio. The current stock is pricing in something. Hey, what does the market see about the future of this company? The market expects this company to grow in the future. If you look at that big price to earnings spike, you can see the stock's trading around 45 at the time, now currently trading up 100%. Next on the scan is VRT, Victor Romeo Tango. Taking a look at this one, wow, this also has a rapidly increasing price to earnings ratio. When we come off of the 0 line here, just from when the company had no earnings, it initializes at 12. Then goes from a 12 PE ratio pretty rapidly up to about a 32, 33. That instance, you could take a look at this stock and you could say, okay, why has the price to earnings ratio tripled on this stock? What does the market see? Why is the market expecting so much future growth out of this company. And even since then, I mean, yes, look, are you buying high at the time? Are you looking at this and going, wow, who the hell would buy this stock? Look at how overvalued they are and how stretched the price chart is. I mean, how many times have you heard somebody say something like that about a chart? Once again, I heard people saying it about Nvidia in 2021. Look at what's happened with that thing. And on this ticker, you've gone up over 200% since then. If we just keep going down the list here, look at a couple more. I see Chipotle and I see Uber. Those are two companies I know. CMG. Okay, very nice. So let me move myself to this side because I want to take a look back here at when the price to earnings ratio on Chipotle goes from 45 rapidly up to 95. Hey, why did the price to earnings ratio on this thing just double? What is the market seeing for future growth in this company? Once again, since then, stock up over 170%. Next, there was Uber on the list. Here's another one where the PE ratio, currently sitting at 87, has just been rapidly growing since Uber turned profit. Initialized PE ratio at 33, which immediately is high. Hey, this, the stock has high future expectations according to what the market is currently valuing, then rips from 33 up into the 50s. You can start to take a look at this thing. Why is the PE ratio growing? Of course, once it crosses over 50, it would begin appearing on our scanners. And since then, the stock has just about doubled in price. Hit like if you learned something, hit subscribe if you would like to learn more. And that PE ratio indicator and scanner, along with over 70 other custom indicators, scanners, and even trade strategies, are all available for easy import into your Thinkorswim application from my website, daytradingstrategies.net. Link in the description down below. Go sign up and become a better trader today. With all that being said, I'll catch you all in the next one.